Greetings, members, one and all of the Salivation Nation. As most of you know, I don't really dabble a whole lot in the stock market, but AUGCH sent along to me this link to Visual Capitalist infographic on 7 facts that will free you from the fear of stock market crashes. Let's explore and see if we can make sense and see how this can teach us a lesson, not only for those of you who do engage in stock market trading, but also for those of us who acquire precious metals, and how these lessons can be transferred into the world that we are so familiar. How to become unshakable. These 7 facts that will free you from the fear of stock market crashes. And this is pretty well laid out by Visual Capitalist. The current bull market in stocks is closing in on 10 years in length. This was actually made before the big volatility that we see now. But I think it's an important lesson to kind of keep in mind as to how we can protect ourselves and how we can view some of these things in relation to what's considered, a time to be afraid and a time to be bullish. The current bull market stocks closing in 10 years, making the longest run in modern history. And this makes people very nervous. You can see here, we've seen this bull market here in previous periods from 82 to 87, 60 months there. From 74 to 80 was 74 months. And from 49 to 56, it was 86 months. From 90 to 2000 was 114 months. Look at that big climb. And from here, from 09 to 2018, that's 115 months, and that's of September of 2018. And shortly after that, we started to see the volatility. And it makes people nervous, and understandably so. I know I've talked about it on my channel, that, sooner or later, something's going to have to give, and we're seeing that come into play now. So everybody does remember the mayhem of 2008, and with the stock prices at an all-time high, the fear of a market meltdown is a valid concern for many investors. And we saw there in the crisis of 2008, we saw the unemployment rate go up to as high as 10%, and 3.1 million foreclosure filings. Bull markets don't last forever. Winter is coming, and here's what we can do about it. Preparing for the cold. Humans have thrived throughout history because of our unique ability to recognize patterns. As an example, by discerning how the seasons worked and understanding that winter came once every year, humans were able to harness these patterns to successfully grow crops and thrive. We acted on this pattern again and again, and over time it has created massive amounts of food in abundance. Just like the pattern of the seasons, there are clear patterns in financial markets that are evident through many decades of data. And understanding the following 7 indisputable facts, you'll be able to prepare for the seasons of the financial market, including winter, and it will give you an enormous edge over even many sophisticated and experienced investors. So let's see how this bears for those of us who acquire precious metals. And again, I fully recognize there's many of you out there who not only invest in the stock market, but also acquire precious metals as a hedge against economic and financial instability with these markets. And I think that's wonderful. And we're going to explore this and see how this ties in here. The first fact is that on average, corrections happen about once per year. For more than a century, the market has been close to 1 correction per year, decline of 10% or more, but not more than 20%. In other words, corrections are a regular part of the financial seasons, and you can expect to see as many corrections as birthdays throughout your life. On average, the correction looks something like this. 54 long days occurs once per year on average, 13.5% market decline. The uncertainty of a correction can prompt people to make big mistakes, but in reality, most corrections are over before you know it. If you hold on tight, it's likely the storm will pass. And so are we living through that right now in this season? As of the recording of this video, the market has corrected again to the upside. because of good economic data, jobs, and the like, and adding a lot more jobs. So we'll see how that plays out. The second thing is fewer than 20% of all corrections turn into a bear market. That's an interesting notion here. When the stock market starts tumbling, it can be tempting to abandon ship by selling assets and moving into cash. However, doing so would be a big mistake. You would likely be selling all your assets at a low right before the market rebounds. And I would just say that, a lot of people in this community, they are, and I'm one of them really, that does question the stock market, and it is a risk, just as any investment is a risk. And it says by moving into cash. In our case, that can, I would say, for most of us in this community, it also means gold and silver. And I would say probably it's a good idea to accumulate both. If you're in the markets, I would certainly encourage you to stay in the markets, but have that protection with gold and silver as a part. Some people say between 5 and up to 20% of your assets into cash or into a gold and silver. And I also believe in having cash on hand in a savings account if you need quick liquidity for emergency situations. Some say up to 3 to 6 months worth. And the reason why is because fewer than 20% of corrections turn into bear markets. Now, this particular volatility that we're seeing now and what's been happening in the markets, I think is unique. And I believe that 20% may not apply right now, considering how bullish the market has been and for how long has it's been and why it has occurred. There's a lot of artificial liquidity put into the markets, in my opinion, from quantitative easing, which to me means that this fact number 2 may not necessarily apply in this situation. And there's a lot of people that have legitimate fears why that's the case. To put it another way, they say 80% of corrections are just short breaks in otherwise intact bull markets, meaning that selling early would make you miss the rest of the upward trend. And yeah, that does make sense. There's a lot of psychology here. And the thing is how high will it go? When you invest your money in a stock market in an already overinflated stock, how much higher can it go? The higher it goes, the less likely that it will go higher, really, and for you to really make money on that investment, as opposed to when it is low and there's a potential for it to go high. But again, it's risk assessment, and there's a lot of psychology involved in that. Number 3, nobody can predict consistently whether the market will rise or fall. And I do agree with that. The media perpetuates a myth that if you're smart enough, you can predict the market's moves and avoid its downdrafts. But no one can really time the markets. And many so-called experts have made hundreds of market crash predictions in recent years. And let's take a look at those. Going back here in 2012, prepare for a stock market crash from Jonathan Yates. Market Watch said, watch out for a correction or worse. Well, I don't know that would be, I don't know that you could necessarily say, watch out for a correction or worse would predict a crash. It could be worse. Anything could be worse. But Bill Gross says, don't buy, sell risk assets. And then Market Watch Doomsday Poll, 87% risk of stock market crash by year's end. And it goes on. And then here, Barron's, I don't think that's necessarily predicting a crash. It just a 20%, I guess, be right at that level. And then all these different kinds here. And the ones here towards the end, gloom, doom, boom. Gloom, boom, doom. Asset holders will lose 50% there. And then the markets are Guggenheim. The markets are potentially in a collision course with disaster. 70% collapse is looming in July from Ted Bauman. So they're getting much more bold in their predictions here towards the end as the markets are going up here and towards 2018. And it very well could be something's happening. We don't know. Every one of these predictions was wrong. At least at the time they were wrong. But timing is everything. But I don't know that necessarily, I don't know that I would say for sure, especially with some of this stuff. You know, considering what's been happening in the past, I don't know that they are wrong, considering how much cash has been put into the markets from the quantitative easing, the bubbles, artificial bubbles. Warren Buffett says the only value of stock forecasters is to make fortune tellers look good. Yeah, I mean, there's a lot of psychology in the markets for sure. And, you know, and again, I'm not telling people that they should, you know, abandon the markets or the like, but just be cautious in the markets, and have a bit of insurance. The best insurance that you and I know here in this community is gold and silver, and on a secondary note, cash. Number 4, the market has always risen despite short-term setbacks. Market drops are a very regular occurrence. For example, the S&P 500, the main index that tracks the U.S. stock market, has fallen on average 14.2%, at least 1 point each year between 1980 and 2015. Like winter, these drops are part of the market seasons, and over this period of time, despite these temporary drops, the market ended up achieving a positive return 27 of 36 years. That's 75% of the time. And under normal conditions, under normal injections of, or, you know, economic activity, I would tend to agree with this. But because of the bailouts and how the reactions to the government from the 2007 crisis, the overreactions, big time, I no longer agree with this, that what is happening, that false bubble. And then I think from 2016 onwards, I think the stock market has risen because of natural market conditions. But that's on top of an already bigger bubble of unnatural market conditions. So I no longer have the faith that the market will recover, at least in the way that it is now. I think we're calling to a correction that will negate those gains from the earlier period, from the quantitative easings 1, especially 2, and even more importantly, quantitative easing round 3. They're saying the market generally rises over the long run, even though we hit a huge number of potholes along the way. And that has been true. That has been true. That's for sure. But I don't know, again, that will necessarily be the case moving forward, considering what the Federal Reserve has done. Over the period of time, there have been multiple wars, the worst financial crisis since the Great Depression, and many other roadblocks. Despite this, the market is still up, and that's true. But again, how do we get out of the worst financial crisis since the Great Depression? It wasn't by that which made the country great in the first place, and that is free market enterprise. It was essentially injection of cash by the Federal Reserve and government intervention, bailouts. It's a false sense of a bull market, and that's what concerns me. But if that wasn't there, I would agree completely with this. In fact, my financial advisor, when I cashed out my prior job's IRA, told me that. But I mentioned to him about quantitative easing, and I was concerned about that. And we really have yet to suffer the consequences of quantitative easing yet. But nonetheless, and again, I'm not telling people to get out of the markets per se. There's people in the community, people that are on that collect and acquire and stack gold and silver as a hedge, as a way to protect themselves, and that is so important. And I think as long as you have that, you are protected, at least with some of your holdings. Number 5, historically, bear markets have happened every 3 to 5 years. In the 115-year span between 1900 and 2015, there have been 34 bear markets. In those situations, stocks drop 20% or more. And here we can see those. And yep, that's exactly right. Look at that. There are those. And look here, 2007 to 2009, we had a 57.6% drop. Huge, especially compared to these others. It's by far the largest. That's scary. that alone and the reaction of the government and Federal Reserve to that is the alarming and concerning thing. Bear markets don't last. This one didn't last because of government intervention, but it was a false sense of a recovery. And even as such, even with the market's injection into the with the government's injection of the market with cash and digitized zeros and ones of C notes, even as such, from the period of 2010 through 2016, really, it was the most stagnant recovery in American history. Bear markets become bull markets, which is point number 6. Remember how fragile the world seemed in 2008 when the banks were collapsing and the stock market was in free fall? When you picture the future, did it seem dark and dangerous? Or did it seem like good times were just around the corner and the party was about to begin? And here we see some numbers here. From bear to bull market, 46, 47. Look at these numbers here. And look at the bottom. Well, 1990, it had went up 69%. The fact is, a bear market ends the following 12 months can see crucial market gains. But what caused the gains this time? It wasn't natural market forces, artificial. That's what's concerning to many of us in this community, for sure. The greatest danger being out of the market. And this is where I kind of, in a way, kind of disagree. From 1996 to 2015, the S&P 500 returned an average of 8.2% a year. But if you missed out the top 10 trading days during those 20 years, your returns dwindled to just 4.5%. So we can see here, and again, that may be some case, could be the case. And again, this is just generally. There are other stocks that do well. There's so much out there. Not only do you have the Dow Jones Industrial 300, but you've got the Wilshire 5000. And there's a lot in the market that you can put your money in, and it will work for you as an investment. And so I do agree with this. And Tony Robbins says here, you can't win by sitting on the bench. You have to be in the game. To put it another way, fear isn't rewarded, courage is. And that's true. And a subscriber of mine did say as such, posting that since the markets were down a particular day drastically, it was a time to buy. And for those of you entrepreneurs out there, or those of you risk takers, by all means, go for it. You may return your money. You could make some big gains in these times. But it is a risky venture. I'm very risk averse, which is why I accumulate gold and silver as a way to protect myself in times like these. But I would say that this particular infographic would be true. And in a normal situation before the market crisis of the housing crisis of 2007, 2008, and reaction of the government. He said, let's say you had $2,000 of cash to invest for each year for 20 years, starting in 1993. The perfect timing, you had $87,004. If you stayed in T-bills, $51,291. Bad timing, $72,487. So anyways, yeah, the lesson is if you stay in the market long enough, compounding works its magic and you end up with a healthy return. And yeah, and I do, and again, I would agree with that on a general consensus. And because most of us through our employers, we do have money in some markets, and I do at my present employer too. I don't really watch it or pay attention to it. It just does its thing, in a pretty conservative fund. And I think that's just it, safe funds that will grow a certain amount over a period of time. But by and large, I think most of us in this community understand what's going on and how the government has been doing things over the past past 10 years or so. And our view is that the markets are artificially inflated. Hence, why we protect ourselves with gold and silver. And who knows what's going to happen to the markets. But I'm less and less encouraged by that infographic now, considering current market conditions and the state of the economy, and what could happen because of what had been occurring with this artificial injection into the markets. I'm hoping we will pull through. We very well could be. I do agree with the point that you can't really predict the markets, and this could just be a correction, and it could bounce back. It's in everybody's best interest that the economy does well, that the stock market does well, especially those that are in the game, so to speak. So, and we know there's manipulation as well. But nonetheless, I think the key is, and I do agree with the overall fact that, hey, if you've got money in the markets, I wouldn't encourage you just to totally abandon it, even though I don't dabble in them. But if you're coming across this video and you are not familiar with the hedge that is provided with gold and silver, I would encourage you to consider gold and silver as another way to protect yourself against economic instability. Because no matter what, I'm hearing even on a regular mainstream media news sources how the markets, the reaction of the markets taking a dive this day, and then gold and silver rising the next or the same day. And then the most recent, I heard on major news networks that the markets have recovered because of the bullish job report, and hence gold and silver took a back seat and have gone down. So they're talking about them as safe haven assets, and that is so important. And I believe if those in this community and outside of this community could accumulate a little bit of gold and silver to protect yourselves, as well as have a solid savings account of cash, then I believe you'll be better positioned when the time comes. And it will come when we'll have a recession. And this didn't talk about a recession, but typically the stock market is one of the factors. If it falls enough, that could cause confidence to wane, and we could see GDP growth go down, a lot of different things to happen, and of course the inversion in the bond markets. And then if that occurs, we'll see an economic downturn, and gold and silver will protect us during those times. So I hope you found this video helpful. And again, thank you to AUGCH for sending along that article to me. I'd like to extend a multitude of gratitude to you all for watching, and encourage you to please rate, comment, and subscribe.